And I'd love to bring up our great moderator, Jeff Gellis. Jeff writes about consumer issues and technology for the Philadelphia Inquirer, where he's been consumer columnist since '01. Jeff began his career at the St. Louis Post-Dispatch and has been a writer and an editor at the Inquirer since 1982. And since the financial crisis, he has also written about economics and financial reform. So I know many of you have questions for Raj. Please do put them on your note cards. We will collect them. We'll be coming down the sides to do so. And let's bring Jeff on now. And thank you very much, Jeff, for joining us and for being our moderator for the Q&A. So welcome, Jeff Gellis.
So I know the audience has a lot of questions, and I've been invited to get you started with one of my own, so here it is. Many of the current arguments from Republicans in particular seem to center on the idea that regulations, particularly the prospect of new regulations, are a drag on the economy and on the prospects for recovery. Can you address why that is or isn't true?
It is a good question. I'm happy for the chance to get at it squarely. There is a notion, I know, that in general, rules require compliance burden, and compliance burden costs money, and therefore that is money that is not used otherwise in the economy. But we also have to remember how it is that we got into this state in the first place, which is that we had one of the most important industries in the country, because it provides the lifeblood of credit to other industries, that was allowed to run off the rails principally due to inconsistent regulation. It was quite literally the case that the rules that applied, say, to community banks did not, in practical terms, because of a lack of supervision, apply to other players within the marketplace. And if you have an important industry where only some of the players in practical terms have to follow the rules, well, then you shouldn't expect great outcomes. So to my mind, sensible, pragmatic regulation of financial services is a necessary element of a vibrant economy in the United States.
Thank you. Go to some of the audience questions here. Can you discuss what specific steps the CFPB plans to take against payday lending and those sorts of non-bank institutions?
Yeah, payday lending, which is indeed one of the short-term credit products that in some ways you can view as a rough substitute for some checking account overdraft products and otherwise, is one of the product areas that the Congress told the Bureau to exercise supervisory authority over once we have our full authorities, which is a very important thing, because from a consumer's point of view, at least in some circumstances, you could easily see how payday loans on the one hand or overdraft on the other or other products, to the extent that one is making a decision between them, well then in general the same sensibilities had ought to inform the rules of the road that cover them. And so it is a very important extension of the Bureau's, of our overall financial regulatory apparatus to make sure that non-depositories are subject to the same kind of supervision as indeed all the banks in the country are.
Here's a straightforward question. When will one of the people who crashed our economy go to jail?
This is a question that is probably more appropriately addressed to my wife, who is a criminal fraud prosecutor at the Department of Justice, so I'll just ask her that. But at the Bureau, enforcement is an important part of our mandate. And in some ways, our approach to enforcement is going to be better informed, I would argue more sensible and more highly effective, precisely because we have other tools at our disposal. And in that way, we're going to be able to make sure that when enforcement is the right tool to use, I assure you, we will not hesitate to use it. And of course, we will work with including the federal and state authorities to make sure that enforcement, broadly speaking, is undertaken.
Question about student loans. When long-term money is now, this says, I think, 4%, but it's very, very cheap. The federal funds rate is near zero now. Why are student loan rates around 7 or 8%? As the parent of a college student, I'd like to know also.
Well, you should have some sympathy for me. I have 2-year-old twins, so if the rate of tuition increases, because we either have to have twins who are very, very smart and can be on scholarship, or have no interest in college at all. That's basically what we're looking for. The cost of any consumer credit product is driven by a lot of things, but one of the things that really allow you to be confident that you're getting a real market clearing price, the quote-unquote right, rational price, is when both providers of a product and consumers of a product kind of are looking at the same deal. And so I'm not speaking specifically about student lending necessarily, but in general, if providers and consumers aren't seeing the same set of terms and understanding the same kind of deal, then you shouldn't be supremely confident that the market price is sort of the efficient one. And that's generally true, and that's why it is that I think it's important that we restore some real order to consumer protection and regulation here.
There is a proliferation of debt settlement operations, many already targets of several state attorneys general. Many seem to be engaged in a pattern of false promises and outright theft and breach of promised fiduciary duties. Is the CFPB addressing this serious and growing problem?
Debt settlement, to the extent undertaken by non-depositories, is exactly one of the areas that the Bureau uniquely has the ability over time, and if warranted, to be able to exercise authority where federal banking regulators, for example, have not been able to do that in the past. So again, it's one of these areas that when people think about financial services in mainstream America, they don't necessarily think about the very many firms that are not banks or thrifts or not depositories, but in fact, for many people, can be an important part of the financial services landscape.
Can you expand on that? What's the status of the large participants proceeding, where I guess that would be where you might be able to take supervisory authority over debt settlement?
Sure. Why don't I provide a little bit of context around it? The supervisory authority of the CFPB, which is literally the authority to be able to examine institutions with respect to their compliance with federal consumer protection laws, applies, broadly speaking, to 2 sets of institutions. The first is depositories, so banks, thrifts, credit unions with greater than $10 billion in assets. And at a holding company level, that's about 111 different companies. And non-depositories, of which, for example, debt settlement companies and most payday lenders, et cetera, are non-depositories. Our non-depository supervisory authority, in turn, you could divide into 2 big categories. On the one hand, it's 3 specifically enumerated markets: mortgage, payday lending, private education lending, for which the Bureau has supervisory authority across the range of institutions. And then for all other non-depository markets, we have supervisory authority over the larger participants in those markets. And what we have tried to do in the spirit of transparency under which we tried to do everything is reach out to the public to get thoughts and perspectives and comments on how we should think about how to define what a larger participant in such a market is. And so we will get, and we have been, and we will evaluate those comments, and it'll really inform our thinking about figuring out, well, what's the right and most effective way to move forward.
This questioner would like you to please comment candidly on what powers the CFPB would ideally have that were not bestowed by Congress.
Candidly, you say.
Candidly.
I think that the design of the CFPB is a really striking step forward in the prospect of sensible regulation in financial services in this country. Consumer finance is a gigantically important part of the overall economy. And the notion that we put the existing federal regulators who are staffed by hardworking and diligent people, but put them in a position where you had a patchwork of authorities, was not an especially promising way to hope for success. And the design of the CFPB, I'm very happy, addresses those major problems.
This question pertains to the efforts to combine the good faith estimate and truth in lending forms. At this point, we've seen several examples of draft prototypes. When can we expect to see a proposed rule? And can you tell us anything about what the regulations will look like?
So with respect to what the proposed regulations will look like, I mean, part of the reason we're doing all this preliminary work is so that we'll know what the right shape of those look like. But you're right, it's an important point that the various prototypes that we have put on the site and gathered comment on and had lots of people into the office to help us with are before a proposed rule. This is all work that, you know, in the past, in some places, would be done behind closed doors, kind of developing the rough contours of an idea and then proposing it as a rule and only then soliciting comment from the public. And structurally, as a governance matter and a problem-solving matter, our hope is to be able to avoid the potential problem of having a solution that is so far baked and where you're so emotionally vested in a proposed rule by the time it finally comes out that you don't actually end up taking as seriously as one should the comments that you hear. So we're actually inviting the public in before having a proposed rule. We plan for 5 rounds of that public testing before we develop a proposed rule. We just launched the 4th of those 5, and so there's a natural sequencing from there.
The crisis may have been caused by bad mortgage practices, but we are seeing that our clients are increasingly having problems with mortgages because of under and unemployment. How do you reconcile the work of the CFPB with funding for housing counseling at national and state levels? Might there be some role for regulations requiring financial institutions to contribute back to help clean up the mess?
First, with respect to housing counselors and the funding that they need in order to do their important work, of course the Bureau doesn't have any control or on that issue. But it is a gigantic issue. Mortgage servicing, broadly speaking, is important at this particular moment in time, precisely because mortgage is so big and because the ambient level of delinquencies and the state of loans in being somewhere in the process of foreclosure is so dramatically high. There are, unfortunately, this is not a case where some tools can be left on the sidelines. It is a problem of such magnitude that really it's important to marshal all of our resources. And I know at the Bureau, we are making it a real priority to think about, well, what are the common sense rules of the road that ought to be applied to this very big and very important business.
All right, well, I'll follow up with one of my own since we've run out of audience questions. But it pertains to the same issue. You said we got into this financial mess one lousy mortgage at a time when so many people seem to be blaming the financial crisis and the continuing crisis on government overspending. Can you expand a little bit and connect the dots for us as to why 3 years after Lehman Brothers, the economy is in such bad shape because of things that happened now several years ago?
Sure. Consumer spending in the economy is, depending on how you think about it, somewhere between 60 and 70% of the economy. Whether you like it or not, consumer spending, the level of it and the sure-footedness of it and the confidence of it is contingent on the availability of right-minded consumer finance. And consumer finance is simply not something that can be expected to be run well without some rules of the road. If you have rules of the road that don't work, which is what happened during the course of the credit bubble and the ensuing crisis, well then everything falls apart quite quickly. Consumer finance as a method of extending credit fails to work, it starts to break down. Consumers' ability to be confident in spending naturally begins to break down, and it slows the entire economy, which in turn impacts everything else that we do. So naturally, although I'd like to say that the CFPB is the entire part of the answer, it obviously is not. But having right-minded and sensible regulation of consumer finance is a necessary part of the answer to move forward.
Thank you.
Thank you.
Wonderful. Thank you both. Thank you, Raj. Thank you, Jeff. And terrific.